If you want to understand how the ultra wealthy are investing their money, then look no further than Tiger 21. It's an investment club for the ultra wealthy. We're joined now in the stream by Tiger 21's chairman, Michael Sonnenfeldt. Michael, thank you so much for joining us.
Thank you. Great to be here.
Well, let's start with where the folks in Tiger 21 are putting their money, some of the changes that you all saw based on a member feedback questionnaire, real estate, private equity, those seen, I guess, put that in context for us, were they seeing more gains in 2020? Where were folks putting their money?
Sure. So just to put a context, today we're about 850 members. So you're looking at about 85 billion in assets in what you're recording. And this year was a year of huge change. Earlier in the year, in March, cash skyrocketed from 12% to 19%. We'd never seen anything like that in over a decade. And now it's fallen back down to 16%, meaning people are getting more confident. They're not highly confident, but things are stabilizing a bit. And over the year, they did make changes. They liquidated first the public equities because those were easiest. But as things stabilized, started tiptoeing back into real estate and private equity, because that's where our members created their wealth so they can spot a great opportunity when it happens.
So Tiger 21, help us understand. We've all had mentors, but Tiger 21 teams people up who are high income or net worth individuals. Break that down for me. Are we talking people with an income of $250K a year? What's the definition?
No,
and then how does the network come together to help?
It's post-income. Our organization is for entrepreneurs who have had a liquidity event, generally sold their entire business, been bought out of a business. They've been running it 20 or 30 years. We manage, our members have between 10 million and $1 billion of net worth. They're no longer earning salaries because they've sold their business, and they come together in groups, 70 groups across the globe. It's the largest network, and we're part of what would be called peer-to-peer learning, So when you sit in a group with 12 or 14 people of relatively equal success, and by the way, that level of success is just like being in the major leagues. In the major leagues, football, baseball, basketball, you're 1 in 17,000 by accomplishment. To be in Tiger 21, you have to be 1 in 10,000 by accomplishment on average. And you're learning from people who have sold businesses before or will be selling businesses. And we're big believers that experts are important, but you could keep experts on tap. The real learning comes from somebody else who's sitting in the same shoes that you are now, or maybe they already sat them and figured out how to go.
So, Michael, I imagine you have a very unique insight into what the ultra wealthy are doing. We keep hearing or seeing headlines around exoduses from states like New York, California, people relocating to Austin, Miami, other places like that. You all did ask a few questions about folks. Have they changed their primary residence, I suppose, during the pandemic? And would they consider changing if their taxes went up? Help us contextualize. What is the trend? Is there a trend? And what are you kind of hearing from your members as it relates to some of these things?
Sure. It was an amazing survey that we just did of our members. And basically, members started saying when tax rates change by more than 5% within a state, as happened as an example when they eliminated the deductibility of state and local taxes, they're going to start moving. Sometimes it's just economic, and sometimes they feel like the money is being wasted. An example that comes up constantly is if you could have paid the $3 billion subsidy that would have got Amazon to come to New York, nobody talks about the $20 billion in benefits that were lost. That would be a good tax expenditure by most of our members. But when the money is spent in ways they don't believe is productive, they start really wondering whether they're getting value for money. It's not all people. Many people love where they are, and for a few extra bucks, they're not going to move. But you have this train from California, Silicon Valley to Austin that you read about, from New York to Miami. And clearly the pandemic accelerated what began with the SALT deductibility elimination.
Michael Sonnenfeldt, Tiger 21 chairman, I thank you so much for joining us. And